Let's talk money.
Welcome back to today's edition of Let's Talk Money. And this week we are demystifying the world of quant investing and quant funds. Now, we've discussed, of course, how these funds are set up, what are the factors that go into these funds, and how their basic construct works. Harish, I have to ask you this question. The returns, right? At the end of the day, everybody wants to get some reasonable idea of how such funds perform. I mean, and sort of what's the motivation? Why should I opt for a quant fund versus a regular diversified fund, which is supposed to give me at least, like, let's say, 12 to 15%, depending on the year?
Sure. So I think you made an interesting point of active and passive, right? Active funds have active proprietary insights, but very poor repeatability, in the sense that when a similar circumstance is coming, will you be reasonably sure that you will get a similar outcome is not necessarily what an active manager generally gives. A passive, on the other hand, has got no proprietary insight. It's all basis public knowledge, right? But it has got very high repeatability. Quant strategies, on the other hand, have active insights. We don't have to let the whole world know what exactly we are doing. While we give a sense of what those 4 decisions are, we're not going to say that in June there's going to be so-and-so rebalance, right? More importantly, it gets you that repeatability. So the reason why you want to be into quant funds is more for the repeatability aspect along with that active insight. Now, coming to your point as to, what are the returns one can generate, etc. Now, the passive factors, of course, have generated reasonable amount of returns from a risk-adjusted basis, etc. Right? Momentum is a very popular factor that's done exceedingly well in India as well as the rest of the world. We've generally seen alphas which are more like 4-5% over, say, the traditional markets over, say, 3-5 year kind of cycles. That have come through because essentially...
So this is a 3-4% alpha outperformance over the benchmark, you're saying?
Over the market, over the broader market. Please remember that when we talk about factors, we are basically talking about a niche in the market. If we own the market, we'll get the market factor, market return, right? We are essentially either looking at momentum or volatility. These are all niches in the market, right? And depending on how you therefore blend in that recipe, you get in a certain amount of repeatable kind of a return. There is no free lunch. It doesn't mean that, adopting a particular factor or a particular strategy will keep giving you alpha every time. If that was the case, nobody will be in the market. Everybody will be in that. So these are niche products, but then they've generally seen that they've given these kind of returns over a reasonable amount of periods in the past.
Okay, now you tell us which one of these 5 factors do you like the most? And when you are setting up, the quant fund that you'll be managing, then what's the thought process? What's the strategy there?
Right. So our starting point is basically the top 75 positions in each of the fund houses, right? So like I said, human fund managers are very good at avoiding bad companies. And that is one area where machines typically can go astray in terms of getting confused as to where to harvest the signal, right? But in the top 75 positions of every fund house is generally the most high conviction bets that you have. The top 75 positions in a fund house account for roughly 80% of AUM. So therefore, you have a very good, solid superset. So if at this point of time, if I were to talk the top 75 of Birla, top 75 of Axis, Kotak, etc., and you create a whole superset, we are talking about 240 names. Right?
So a lot of overlaps, I'm guessing.
There are a lot of overlaps. There are some unique names.
Fund houses everybody wants to own the good company.
Yes, right? And there are some unique names, etc. So from there, we are basically avoiding the small cap. So this is primarily a large and mid cap kind of a product offering that we are doing. Over there, we are primarily looking at 3 factors. We are looking at the quality factor, we are looking at the momentum factor, and we are weighing it by low volatility. Right? So these are the 3 factors that we are blending it at this point of time, which is primarily looking at the momentum signal, in a very high quality universe, because this has all come from the might of the wisdom of the fund managers in India, which are all wanting to create alpha in their respective funds. And therefore, they're putting some of their best names out there, and where the chance of going terribly wrong are very little, right? And over there, we're taking the momentum factor, and the names that are coming through, we are weighing it on the basis of lower volatility. So if you think from a cricketing analogy, right, we want to create a World Cup team for T20, and now it's the World Cup season. One option could be that, I can pick up a signal of, say, 2 or 3 different statistics, formulas, if you will, from all the 5,000 players. And then I assemble a team of whatever, 20, 30, 40 players, and then play their matches. The other could be that I pick only from the IPL teams, which is what we are trying to do. We are buying it from the mutual fund.
Yeah.
Within that IPL team also, we have certain set of players who play almost all 80% matches. Some are just, impact players, substitutes, etc. We want to see players who have performed in most of the pitches.
Yeah.
From there, we are looking at the form in IPL, which is the momentum factor, which is the past form.
Right.
And we are trying to arrive at something wherein we are looking at forward expectations of earnings, etc. to arrive at a superset of names, wherein we are weighing it on the basis of long-term consistency.
Yeah.
More the consistent a player, the higher the weightage you give, or lower the volatility, which is another word for consistency, you give higher the weightage and vice versa. So it's not very different from what we do in everyday life. It's just that there is a particular rule through which...
There's a sort of a method to it.
There is a method to the madness of this quant fund.
Got it. So you're looking for a very, very sort of high quality stocks which have momentum and yet are going to be low on volatility.
That's right.
Okay, so it sounds like the holy grail, right? And then that's what you're going after. Pretty interesting. So just to go back in terms of how investors should approach such quant funds, whether it's yours or any other fund houses, in terms of the overall portfolio, what place should quant funds find in the portfolio in terms of as a percentage maybe, or how do you blend it in with your overall portfolio?
So, see, quant funds, like you said, you're trying to demystify it. Today, it occupies a very niche or a fringe position in most portfolios. We would think that it should come more and more into the core of the portfolio. And that can only come when we give away our recipe book, and which is what we are saying, that this is the steps that we are following in terms of each of these 4 parameters, right? And that should give confidence that we are not going to get a very bad name or a very bad experience, so that people can allocate more and more. We are talking about large and mid-cap offering a very large space in already people's portfolios. This is just going to be a bottom-up, benchmark-agnostic fund offering out there.
Sure.
So we would think that, people can come in with a lot of core allocation into this kind of a category. Once they begin to understand the nuances of how exactly the portfolio is getting constructed. The one thing that we would say is that because this is a niche from the market, on a daily basis, you are having a very different portfolio from the market portfolio. So here, what we call the active share, which is how different is your portfolio from the benchmark, will be as high as 80-90% different from the benchmark. So this is going to be very different from any of the other funds that you any which case own.
Sure.
Right? So this brings in a diversification benefit,
Got it.
which may not be there in other funds. So this is not a Me Too product, but even if it is selecting from the core large and mid cap, which is there in every other fund house, from there only we are picking up, the weights and the way in which we are selecting it will make it a very differentiated portfolio.
Compared to the benchmark.
So
just simple analysis on, okay, this is the benchmark, how much is the fund returning over the benchmark may not be the right way
to look at it. More importantly, you need to give it 3-5 years. See, even with the selection framework that I explained, say a World Cup match, it's not that, India will keep winning every match. There'll be matches where we'll be 36 all out. There'll be matches where we score really well, right? But when we score a 36 all out, the process will tell you what exactly has to change and how it will change, how the portfolios will change, so that we get more of those cases where we start winning. That's really, in simple terms, how quant investing works.
Harish, it's been a really helpful conversation. Thank you so much, because quant investing is the new frontier. It is a more evolved way of investing than what perhaps the industry has been sort of putting forth till now. So we're looking forward to more conversations and to understand how these funds evolve and shape up as well. So good luck to you and, of course, all the fund managers out there who are trying all these new strategies. May the investor always win.
Thank you so much.
Thank you so much. Well, with that, we're out of time on this episode of Let's Talk Money. Keep sending us your feedback, your comments, queries. See you again next week.
Let's Talk Money